The company we chose to analyze is Ecolab, and the members of our group are Brooks Andrus, Joseph Drasso, and Joseph Goff. Ecolab was established in 1924 in Delaware. The original name was Economic Laboratories. They are now based in St. Paul, Minnesota. Their primary business is selling soap and cleaning supplies to hotels, restaurants and resorts, prisons, hospitals, and the like. Their mission statement is circle the customer, circle the globe. They employ their own sales and service teams. This means that in each city or nearby city where they have a customer, they have employees who can service them. This is especially useful in emergencies and when they have mechanical problems. They operate in 170 countries, and some of the divisions they have include institutional. That means the hospitality industry, water, food and beverage, paper, life science, textile care, and health care. Their ideal customer is in the hospitality industry. The reason for this is, for example, Marriott. Marriott has hotels, and in their hotels, they need cleaning supplies for their bathrooms, their rooms, the kitchen. They usually have some sort of water feature, pool, hot tub, pond, that needs to be cleaned and purified. Tap water needs to be purified. They have sheets that need to be washed. Some other companies to note that is an ideal client for them is like Bellagio and Carnival. Some of the economic risks that Ecolab faces include domestic and global translation, legal environment, political environment, and regulation change. They store their own data and have created their own ERP system. So if their ERP system goes out, they might not have enough product on hand when a client calls and requests it. They also have client information that the clients would not be happy if they lost. Another business risk that Ecolab has is raw material pricing and supply. Since they manufacture their own chemical, if there is an increase in the cost of raw materials, that can eat at their gross margin. Also, if there's a shortage of a certain supply, they could be unable to manufacture some chemicals. Risk that they carry is chemical spills. If their manufacturing plant has a chemical spill, they could be liable to restore the land and environment back to its original state. With their clients, such as Bellagio or Marriott, Ecolab signs multi-year contracts. The reason this is a risk is if there's an increase in the cost of raw materials, their gross margin would decrease. At that same token, it could increase if the cost of raw materials decrease. Another risk they have is tax consequences. In recent years, there have been tax changes, and they had to recognize substantial income that was earned overseas. They do not know how this will further impact them, or if there will be additional changes to tax laws. There is also significant estimates in how many tax assets they will be able to recognize. Annually, Ecolab and every company is required to test their intangible assets for impairments. If there is an impairment, they have to recognize the entire loss in that year if they do not expect it to be recovered. Some more business risks include lawsuits. They have one of these going from an oil spill in the Gulf of Mexico from a few years back. Their chemical was used to clean that up, and some parties are alleging that it caused further damage. A risk any company has that has debt is indebtedness. They need to make sure their operating income can cover their current liabilities. Another one that they recognized a few years ago, 10 years ago or so, was when the swine flu was out. There was that was considered a severe health outbreak. This caused the public to eat in their homes and not go stay at hotels as often, which decreased the need for cleaning supplies for the hospitality industry. Ecolab has been working on a spin-off that will complement their business model. They have a risk if this is not ready in time that they might not be able to recognize the benefit of this spin-off or as much of it. And just like every other company, they are at risk for extraordinary events such as terrorist attacks or market failing. In our accounting analysis, when we went to standardize their financial statements, we found that in the selling, general, and administrative expense, $4,095,300 were included special gains and changes, which made up $126,700 of that. Intangible assets of $10,875,700 included goodwill. Other current liabilities of $1,585,800 included compensation and benefits. Other liabilities of $1,269,100 included post-retirement benefits, and net paid-in common capital included combined common stock, additional paid-in capital, accumulated other comprehensive loss, and treasury stock of $906,300. For some of their accounting policies, they have had to change the way they recognize expenses related to multi-year contracts. Instead of amortizing some of the costs, they write it off in the year the contract is incepted. They have significant risk with recognizing revenue on multi-year contracts. They have to estimate how much will be earned in each year. They have accrued liability risk with the pension plan as well as the post-retirement health care benefits. This comes from actuarial estimates. They have risk of restructuring. They are trying to restructure in order to enhance efficiency, effectiveness, and sharpen the competitiveness that Ecolab has. This includes severance packages, which result in more costs. They also have the income tax risk of changes, risk of an incorrect estimate. They have the risk of long-lived assets being impaired, such as goodwill. They have the risk of the fixed translation rates at the end of the year to bring foreign currencies into the US dollar. They have risks they have economic assets that they are not able to recognize on their balance sheet, such as synergy. Within all their divisions that they use to circle the client or circle the customer, they have created synergy and created more value per customer than they could individually with just one division or company. Overall, we believe that their financial statements are inaccurate, accurately reflect their economic performance. Um, However, there are significant risks. This includes estimates. They use a lot of estimates. They also have a fixed translation rate. That doesn't allow us to see how the company is doing in today's dollars with today's translation rates.
All right, so for the ratio analysis for Ecolab in 2018, we got a return on common equity of 18.34%. Basically, this means that 18% of their income was attributed to being financed by equity. I guess that makes sense, kind of wordy. Anyway, so their net operating assets were 15,037,000. That's those are in thousands. And then the return on net operating assets was 10.74. Their leverage was 0.9295 and their spread was 8.169. Procter & Gamble in 2018, this is the company we chose to compare Ecolab with, and I'll explain a nuance with that here in a second. Their return on common equity was 17.75%, which was a slight drop compared to Ecolab. Their net operating assets were much higher at 85,769,000, and their return on net operating assets were also a little higher at 11.58%. Their leverage was a little lower at 0.6259, and the spread was 9.862, so a little higher there as well. The reason why we chose the Procter & Gamble in comparison for these companies was that they have a sub-faction of their company, Procter & Gamble does, that is quite similar to what Ecolab does. We couldn't really break down their financials down to that level, so we had to take the whole big picture. So that could have impacted our analysis. That was a risk we were willing to take. We assumed that Procter & Gamble had similar policies and similar strategies in a lot of their areas. If you look at the ratios, they were really quite similar. They vary between a percent or so, a little more than that with the spread. But really, the biggest difference here is just the sheer volume of assets of Procter & Gamble compared to Ecolab. That's a $70 million difference. It's quite significant. That being said, if you look at why that is only a slight percent difference in the return on NOA and return on common equity is because of how much debt Procter & Gamble had. So really, their assets, obviously, as assets increase, liabilities or stockholders' equity increases, right? So their debt was quite high. If you look at in 2018, it was 31 million, and Ecolab only had 7 million in debt. But if you do a percentage of that, Ecolab had a higher percentage of debt compared to Procter & Gamble. Another interesting thing is that Procter & Gamble did issue preferred stock. Ecolab did not, and they never have. So that also impacted their ratios a little bit. And then just looking down at the net financial obligations, again, that was one of the key ratios we studied. And Procter & Gamble just has high obligations. They have much higher, common equity, much higher debt. They just have a higher volume company, really, in all facets.
So that takes us to the margin analysis. And as we discussed a little bit earlier, Procter & Gamble isn't the perfect company to compare Ecolab to, but they are very similar in certain aspects. So by doing this margin analysis, we're almost able to compare apples to apples rather than comparing different companies of different sizes. So as we look at this margin analysis, we can see instantly the one main thing that sticks out is cost of sales. So if you look at the cost of sales for Ecolab, it's at 58%, whereas the cost of products sold for Procter & Gamble is 51%. A lot of that could be due to economies of scale and the simple fact that Procter & Gamble is a little bit larger than Ecolab, and they probably are a little bit more capable of reaching out to vendors and getting a better price point on certain products or certain ingredients to make their products. If you continue down a little bit, the income before taxes as a percent, a lot of it is generated off of that cost of products sold. If you'll notice, the difference is fairly similar. It's about a 7% difference, and that's making up the main contrast between the two. So if Ecolab was able to take better advantage of the economies of scale, then they'd be a lot better off as far as these percentages go from the margin analysis. Continuing over to the turnover analysis, the one main thing that stuck out in this is the accounts receivable turnover. So from looking at this, you're able to see that Procter & Gamble is able to turn over their accounts receivables 14 times roughly in the year, while Ecolab is able to only turn it over 5 times. So this probably means that Ecolab is running a little bit longer terms, a little bit longer net terms on their sales, whereas Procter & Gamble is able to capitalize and collect their cash a lot quicker. The rest of these are fairly similar. Nothing really stands out. Accounts payable, Ecolab does take a little bit less time to pay their accounts payable, and as we'll see on the next slide, they're working a lot to get kind of out of debt and get more cash is king as a role. So what we're looking at here is the free cash flow to common equity. So free cash flow to common equity is basically the cash that's available for those that have equity in the company, the common equity. So right now Ecolab's sitting at $1 billion in common equity, free cash to common equity, and they have a free cash flow to investors of $1.8 billion. The free cash flow to investors is when basically they take care of all operating costs and sales and everything they need to. This is the money that they should have available to pay investors or buy back their shares. So to see this positive free cash flow is a very good thing for the company as far as its value. A couple activities that stood out as far as their cash activities is they generated $2.2 billion from operating activities, which is incredible. Ways that they spent that money included capital expenditures. They're really big on environmental and health safety projects. They're reaching out to different facilities, trying to manufacture in a better, safer, and more green way. Also, another thing that stood out is that they've paid out $496 million in dividends, which is coming out as a quarterly dividend. They've been able to increase their dividends and pay them out for 82 consecutive years. So if you're looking at a stable company, I think that paying dividends yearly and being able to continually increase that rate is an extreme positive point for Ecolab. And that's our project. We found great value in Ecolab, and we felt that we were able to correctly compare it to Procter & Gamble.